We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Brady, former money manager, Sprott Money and SilverChartist.com contributor, and an expert on all things gold and silver. How are you today, David?
I'm fantastic. How are you, Tom?
I'm excellent. You know, David, this is a great point to talk again, and it's always great to speak with you. But, you know, you and I were kind of discussing before we hit record here this morning on really all these moving pieces, whether it's the CPI print that comes out or the Fed announcement that comes out. It feels like we're at a juncture here where, we see inflation starting to come down a little bit. We see the uneasiness with the banking crisis that have preceded today's interview. How do you try to make sense of the current moment? And is it more so the trajectory that we're on that informs your view on where we're at in the gold and silver prices?
So in terms of the fundamentals that are driving gold and silver higher, the obvious one, we'll just get this out of the way, is the central banks are still buying at record levels. Mm-hmm. And I've been saying since they started doing this that follow the smart money. China's been doing it since at least the 2008 crisis. Russia has piled on too. And ever since then, India is buying silver like it's going out of fashion. And you can probably recite a whole bunch of central banks from whatever country, even Ireland, that is buying gold. So that's the backdrop. You're seeing inventories become depleted, then they refill them, then they become depleted again. At some point, they're going to run out because there's only so much supply, and demand is definitely picking up. The banking crisis definitely kicked that into gear, much like the COVID crisis did back in March 2020, when we saw in April the following month that COMEX almost went bust. They had to turn to the LBMA. Well, we're seeing the same thing now with this banking crisis, because what's causing that is the depositors running from the banks. And where are you going to put your money? You can put it under your mattress. You could buy a bond, but yields haven't been doing too great recently. I expect that to change. Stocks have been just going sideways. Long story short, a lot of money went into gold. Not a lot, but some of it. And that definitely helped. That certainly isn't over. But the main protagonist in this play is the Fed. And the Fed has paused. They said, we'll consider a pause on the June meeting. There's nothing that suggests to me that they will change their opinion between now and then. In effect, the fact that they mentioned pause speaks for itself. And it was the same thing in December 2018, if you remember the stock market crash in October to December that year. And then Powell came out and he said that we're going to slow the rate of, we're closer to neutral than we thought we were in terms of the interest rate. And he still hiked another 25 basis points in January of 2019. But the market got the message. They're basically done. And what happened to stocks and everything else? Off it went. Well, we got the same thing this time around. He mentioned the word pause, that we're considering a pause. Well, then you paused, as far as I'm concerned. And back on November 3rd, which was the kickoff day for gold to move up, that was the bottom for gold, basically. And silver had bottomed in September, but it accelerated to the upside on November 3rd. And the reason for that was when Powell stated clearly that they were going to slow rate hikes going forward. Now, we talked about this before. People consider the term pivot as a complete 180 to rate cuts and QE. Mm-hmm. I don't. I associate it with what Powell did in December 2018. December 19, 2018, which was that they were closer to neutral. It's the shift that's the pivot. The initial shift from rate hikes to slowing, which is what happened on November 3rd. And ultimately, we will get to rate cuts and QE, but that's what's kicked it all off. The Fed is still the main protagonist, I like to say. And I think this is only good for gold going forward, because when they announced the pause in June, is it going to have a huge effect? Not necessarily, because I think that's already priced in. So what's happening right now? What's happening right now is we got a little ahead of ourselves, a little excited when we were approaching 2089 again. The markets are extremely bullish. They were overbought. There were negative divergences left and right. Most people only see this in retrospect, but it was obvious. But, they don't always play out. But this time it did. And now we're suffering a pullback. But here's my punchline. I have said this in articles. I believe this is the last pullback before takeoff. In other words, what I mean by takeoff, we're going to take out 2089. And when we take out 2089 in gold, our close above 2055, which was a double top recently, and if you bring out any weekly chart and you look at the 4 points where they've hit that wall, when we go through that, then it's gone. Because when you suppress a coiled spring, what happens when you take your hand away? Off it goes. And it's the same concept here. When that happens, it isn't just gold, silver, miners, platinum, they're all going to go north. And that's where I am. So with regards to the fundamentals, Fed, banking crisis, two huge ones. I don't want to go ramble too much. I want to give you a chance to answer me some questions, but I do want to mention something I was looking at this morning and I posted on Twitter. Have you looked at the bond market recently? The COT data. The hedge funds are I'll just say massively, I won't say record, but massively short bonds. In other words, they're expecting the price of bonds, the 10-year specifically, to drop, which means yields go up. Who's on the other side? The banks. Now, if it's choice between the banks, so are massively long bonds, which means they expect the price to go up, yields fall. History shows what? The banks are almost always the winners. And it makes sense because, the hedge funds, for some reason or another, they serially get it wrong at extremes. Now, what happens to gold and silver if bond yields start to go down? They go up. What happens to the dollar if US bond yields go down? There's two big factors in terms of intermarket analysis that affect gold. And when I talk about gold, I'm talking about the entire sector, because gold is the big brother and the rest follow. Now, when I say follow, I'll get picked on it. So let me make this clear. Gold determines direction. Silver will outperform gold. Miners will outperform silver. Junior miners will outperform senior miners. But I believe, based on the data and the positioning of the banks, that it's inevitable that we're going to new record highs. And I think the stage has been set. What the banks are doing right now is they're engaged in an organized retreat, is what I call it. They can slow the rise, they can push it down a little bit, but they can't fight the tide. And eventually the dam's going to break. And we've got a clear line of where that dam is. It's at 2089 in gold on an intraday basis. Right now it's 2055 on a closing basis. So once we take those out, gold could hit, ultimately 3,000. Some say 4,000. I'll be happy with 3,000. Maybe the minimum 2,600. Silver I see going to 50 or 60. That's my cat. My apologies. And that GDX also to 50 to 60, and SILJ to 30 to 40. Those are my targets on the upside.
So, David, because I speak to so many people, I get all of these different opinions and ways of the market playing out from this point forward. There seems to be a lot of people that are worried about a big, let's say, deflationary crash or some type of financial event that causes panic and causes everything to sell off. Even the safety hedge and or the piece of the market that seems to be almost the only thing that is standing out, as you pointed out, that people can go into to protect some of the value that they have accrued in their lives. So what weight or probability do you give the idea that gold could go down to, let's say, 1,500 again, or even 1,300, considering the possibility for a broad market correction here, driven by all of this negative data that we keep getting, week after week? It seems like in some ways it's almost inevitable for something to really crash and catch fire here.
Yeah, so I don't disagree that we're going to get a deflationary event. I disagree with the timing. So I strongly believe that whether we are in a recession or not in a recession, I believe we are, that later this year it's going to get a heck of a lot worse, and it's going to turn into a depression, or the start of. You're going to see unemployment soar. We're already seeing bankruptcies soar. Credit cards are maxed out. Savings are gone. Auto repos are happening more and more. Real estate is stagnant now. We might get a little pop as yields come off, but when unemployment bites and people can't afford to pay their mortgage, and actually I've omitted the big one, the banking crisis continues, and the credit crunch that's already underway where the banks are tightening their belts. It's not just about the rate of the mortgages. Do you have the credit quality to get a mortgage? Will they even give you one because they've got their own problems? And then you've got a problem with demand for housing. Everybody talks about, well, supply's low, supply's low. Doesn't matter if demand is zero. And foreclosures increase at the same time, then that's just a double whammy. So yes, I think we're going to get a big drawdown in the markets. But let me ask you the question. First of all, let me say this. I believe the Fed will print at that point. They'll cut rates and print. I don't think it's going to save the markets. Again, it'll be an organized retreat. It'll be a controlled demolition in that situation. So you'll get this stair-stepping down. So yes, we'll get a deflationary event, but if the Fed prints, what you could get, what I expect we're going to get, unfortunately, asset inflation will go down, stocks will go down, real estate will go down, but the prices of goods will go up. And that will have the heaviest impact on the middle class. So where do you put your money in that situation? You've got inflation on the one hand. Everybody talks, this is a good time to talk about this. Everybody talks of inflation in terms of black and white. You can only have inflation or deflation. I'm sorry to break your bubble, But as we've seen many times in the past few years, you can have rampant inflation in goods and services and either stagnant or falling stocks or real estate. So they're going in, you have asset deflation and you have inflation in goods and services. Unfortunately, that's what I see going forward. Now, again, if you have some money, where do you put it in that situation? Assets are going down. You're going to buy real estate? Hell no. You're going to buy stocks? Hell no. If bonds run into trouble, and we can talk about debt ceiling if you want, but are you going to keep it in the mattress? Well, no, not if the inflation's going up. Where's the obvious alternative? It's got to be like Bitcoin, gold, silver, platinum, maybe, palladium. There isn't much else. So even in that scenario, you could have a 2008 event, but there aren't. There are very few avenues to turn to this time around. And I think gold and silver would be the best safe harbor. And I think people are waking up to that. And they did wake up to that in 2008. They used that dip to buy. But I don't think any drawdown is going to be as big. And if it is, it'll be bought relatively quickly. So I'm not disputing that we will get a drawdown. We are going to go into recession/depression. You're going to see stocks have a very difficult time. It could be as early as Q4, it could be as late as Q2 of 2024, but it's coming. Real estate is going to face the same problem, maybe worse initially. And but how does that affect gold? It'll affect gold. Gold will have a pullback. It could be significant, but then it's just going to keep marching higher because the only response these authorities have is to print money. And let's say, people are starving, people are out of work, whatever it is. Let's say they roll out UBI. What do you think that does to the value of the currency relative to a hard asset like gold or silver? I mean, I get their point, but I don't think they're seeing the whole picture. There's too many paper dollars going around. There's confidence is eroding clearly in the currencies. So yes, of course, gold and silver can have a pullback, a reversal, whatever you want to call it. But there's no other place I'd rather be when the proverbial hits the fan. And I personally believe gold is going to go parabolic here in the next few months, latest early next year. Then it gets a big pullback, and then it marches higher again. I think we're going into a multi-decade period where commodities, led by gold and oil, are going to just keep going higher. I don't see any other way around that. But that's my sense. I agree with the philosophy that it could get a big drawdown. I don't think the numbers make sense at 1,300 or 1,500 when we're coming from, say, 3,000. But we'll get a pullback. But I think the risk reward is heavily skewed to the upside, short term, medium, and long term.
David, to your point about people maybe waking up to gold, can we look at what happened around the banking crisis and the rush that many gold dealers saw during that time as an indication of maybe, more of your average people waking up to the safety and reliability of that asset class?
Yeah, I mean, I can speak anecdotally in terms of, when I buy something for my property up north, I get requests, can you pay me in bullion? And I'm like, whoa, excuse me? And that's a first for me. And then I talk to other people and I get the same sentiments from them. So it's definitely happening. And that's just a mirror reflection of what's happening with regard to confidence in currency. Because we saw what happened from March 2020 when the Federal Reserve printed what, 8 trillion. And here we are, trillions in deficits and debts later. And, even the relatively smart person can figure out this has got to have an endpoint. We can't keep, like, what is it now in the US? 32 trillion, give or take. And the deficits aren't going down. I mean, something's got to give. When it gives, you think of countries like Zimbabwe and so forth. Do you want to be, or Germany? Weimar Germany is probably even better example. What would you want to be owning if and when we hit a point like that? It doesn't necessarily mean that you have to bet the farm on it, but people will take out insurance policies. Well, if every person in North America and Europe and say around the world starts to say, hey, I'm just going to save like $50 in silver every week, what do you think that would do to demand for the metal? So yes, I think, because this thing is global, so the effect on the currencies is also global, and the awakening is global. Because I would say, to give credit to the people in the East, they've been all over this for a long time. He who holds the gold sets the rules, and the Chinese have a tradition of owning gold, so the Indians do too. And now Russia's in play, and now it's spread to all the central banks. And they, we're not the only ones, Tom, that see this. Other people can see this information elsewhere too.
I want to go back to, a couple of the points that you touched on. And one of the other ones that I wanted to get your opinion on is this inflationary situation that you see coming. Obviously, if people understand that the value of their currency, when the Fed goes back on their course that they are now, if they see that their value of their currency is being depleted like this, and in conjunction with that, part of their currency being on fire, if you will, the other side of it would be goods inflation, as you said, going up, food and energy, let's say. That really creates inflation from two fronts instead of really one, the supply side that we saw in the last kind of cycle. So does that end up creating a more panicked situation for the average person, which in turn feeds into that inflationary, let's say, spiral?
Yeah, absolutely. I mean, look what happened to here in Canada, and we're seeing it in the US as well, and certainly in the Netherlands. All the talk about, fertilizers and their contribution to climate change, the purchasing of farms, and the effect that will have on the food supply.
Mhm.
Well, if you've got relatively little funds, whether you still have your house or you still have your job, but you've relatively little funds to spend, what do you spend it on? Necessities.
Mhm.
And if food starts to take off in price because it's relatively hard to get, or it's becoming more expensive, everybody's going to be chasing it. And like every scarce commodity, and especially one that you need,
Mhm.
that's just going to drive up prices. I don't think you're going to see the same effect potentially in the likes of lumber or copper, but certainly in your basic necessities, food is going to be a huge issue. And I've seen some commentators mention that everybody's talking about lumber and everybody's talking about copper and gold. Anybody looking at food? It's probably going to be one of the most precious commodities going forward. So, and at the same time, you're going to have asset deflation. So, you've got two sources of wealth: your income and your assets. Well, if you've lost your job and you've lost your real estate, or you've lost your stocks, the value of your stocks are going to drop precipitously. Money is tight. The only thing you're going to be focusing on is buying food, but everybody else is doing the same thing. And if there's less of it, it's going to take off. So you've seen a bifurcation between those two in the past, and I think you're going to see it going forward. You're going to see asset deflation, and you're going to see the price of necessities go through the roof. I talked about this back in 2020 and 2021 when I talked about like inflation is going to become widespread. It's not transitory, and it did. But I also talk about the fact that consumer discretionary products, like I used to say, Gucci belts. Who's buying Gucci belts right now? They suffer deflation. And it was to illustrate the point that you can have both at the same time. You can have deflation in things that you want, but you don't necessarily need, but you're going to have rampant inflation that everybody wants and needs. I hope that answers your question.
Absolutely.
I think it's a combination. As I said, if we run into a recession or depression, I truly believe the Fed, for those that define a pivot as a complete 180 to rate cuts and QE, you're going to get that. Mm-hmm. Is it going to do any good? Hell no. It's just going to drive prices even higher because you're just printing more paper, chasing fewer goods and services. Exactly what we saw in 2020.
Mm-hmm. One of the other points you were making is this idea of the controlled demolition or the maybe controlled exit of these positions by, let's say, some of the bullion banks. So how are you looking at the commitment of traders reports? And is there any way to look at it as a trend over time that could be interpreted as bullion banks trying to, get out of their short positions to avoid a potential short squeeze on those positions that they have?
Well, yeah, I've had a few conversations about this recently. That look, the worst case scenario for a bank caught short in futures market is getting steamrolled by a sharp spike in prices. And two glaring examples for me were palladium in 2018 and nickel more recently, where they actually tore up the trades because the banks would have lost billions. Which we can get into the legality of that later. But yeah, they're not going to get over their skis is my answer to that question. They can, when I say organized retreat, that's what I mean. They will take shots at the market, but they're not going to be able to take it down. Because they can take it down in the short term, but I mean, they're not going to be able to turn the tide. And that's precisely what they're doing right now, in my opinion, is staging an organized retreat because the momentum is with gold and silver, and it's my process uses multiple tools, but looking at the fundamentals, it's hard to come up with a better story for gold going forward. So I don't think the bullion banks are going to risk getting too short, to answer your question. They will wait for opportunities like where the market, like just recently, like last Thursday, when we closed on Thursday, we were extreme bullish, we were extreme overbought. We've come off a nice long rally. Everybody's hoping that we're going to break out to new record highs next. And what happens on Friday? Boom. That was only a small drop. But then they accelerated it. They got the bit between their teeth and down it went. So to answer your question simply, the bullion banks are not going away, but they're not going to be able to stop the momentum. They're not going to be able to stop the current northwards. But they can take pot shots. And quite honestly, I don't mind that because I take those opportunities to buy the dip.
So, David, obviously, another big piece that's in the news right now is this debt ceiling debate, and so many times that we have touched on this on the show, it seems to be always theater. But I think between the Fed and the Treasury, it seems to be a different situation somewhat right now. So, how do you see the value of bonds and this debt ceiling debate once it is resolved interacting, and is it any different this time than any other?
It's only different to the extent that the two sides that are involved in the debate, in the discussion of how much to rise if they raise the debt ceiling, are so polar opposite. Two completely different agendas. The Republicans want to rein in spending. Biden wants to spend more. And yes, we've had that before, but this is extreme. But let's look at the scenarios. Both sides have got something to lose here if we don't get the debt ceiling agreement passed. Because if we don't get a debt ceiling agreement and the Republicans are blamed for it, there's a good chance that whether it's Biden or Harris or some other Democratic candidate in 2024 wins the presidential election, because all hell breaks loose. Whichever side, if they don't agree an extension, and my preferred outcome in the short term is that they're going to just punt it 3 months, and then we'll deal with it again. But if whether it's Democrats or the Republicans at fault, if we don't get a debt ceiling agreement, all hell breaks loose. First of all, the Fed's going to have to print like there's no tomorrow, because the US debt's going to be downgraded overnight, and they're going to have to fit the bill. So there's like, you're printing money out of there, thin air. It's patently funny money. So I don't think there's a benefit to anyone unless your intention is to deliberately bring down the economy. Now, that's a whole other debate. That's a whole other conversation. But if you want to collapse the financial system for whatever reason, or the economy, that's one way to do it, is to have the US default on its debt when it's already 32 trillion in debt and it's got massive deficits. And then the only buyer on the market is the Fed printing money. That's a banana republic right there. So that's Zimbabwe. Nobody's willing to buy our debt but us. So we print our own money to buy our own debt. That's the. So then you step back from that. It's a question of who bears fault for it. But if it's the Democrats, Biden doesn't want to be seen to be the ones to blame. The Republicans don't want to be seen to blame. So I'm surprised that these odds are so short. 60-40 that we will get a debt ceiling agreement. My only concern is it's only going to be for another 3 months. And then we'll be back at it again.
Because of the amount that they're going to raise the debt ceiling by, or because of the amount that they're going to need in order to service all of this?
I believe it's because of the gaping difference in the two agendas. As I said at the outset, I think Biden wants to be able to print as much money as he wants. He wants a blank check. And the Republicans are not willing to tolerate that anymore. They're so wide apart that at best, I think we get a short-term increase in the debt ceiling to avert a default. But they're not going to do it for a year or 2 years. They're going to do it for a short period of time. That's my 2 cents. And then you're back at it again. But that creates its own lack of confidence. As, are we going to get these every 3 months now? That doesn't give you a lot of confidence in the debt of the United States. And maybe it forces the Fed to print anyway. Because, we're already seeing, there's a chart out there looking at that shows central. I saw it very recently, I think it was a week ago, where the central bank purchases of gold on the one hand, and it shows the collective amount of bonds sold by the central banks around the world. And you got this nice move up on the upside in gold, but you got this dump in treasuries on the other side. And the primary ones are like China and Russia, but there are other countries doing it too. So you start getting either a default or you get a punt for 3 months and then another punt. it's a self-fulfilling prophecy that you're going to see all confidence lost in U.S. assets. And what's the biggest casualty in that debacle? The dollar. Now, I don't see that. I hope we don't see that. But to be honest, it's everybody's got an opinion on something, and this topic is one of the most difficult because anything could happen. They could agree on something and we move on. They could punt, or they can default. Nobody knows.
Well, as you're explaining that, I'm going through in my head thinking about the fiscal restraint that I think a lot of people recognize that we need to have. Yet, on the other hand, it's in some ways political suicide to really do the hard thing, to start cutting entitlements, to start cutting, you know, all of this deficit spending that has already been planned. And if the Democrats have promised it and the Republicans stand there and say, no, we're not going to allow this, that makes them look bad. Yet it seems like the easier option is to just kind of deal with, force the debt ceiling higher and then deal with the repercussions of very likely higher inflation from there, down the road when everybody, has other things to be focused on rather than the debt ceiling being raised, let's say 6 months ago again.
Yeah, but you're correct. But at the end of the day, it's a blame game.
Mhm.
Nobody wants to be the one that takes the blame if
Or to do
something
the hard thing.
and to do the hard thing. But that goes back to the other argument, which is, they're so far apart. These guys can't agree on anything because they're like so polar opposite right now.
Mhm.
And neither of them wants to look like the one to blame. And that's why I take the third option is they're just going to punt it in the short term.
Mhm.
Kick it down the road a little further. Again, and then where my mind goes to the dark side, as I like to think, unless somebody wants to crash the system and usher in the Great Reset, that's the only other alternative. So you've either got they're going to have to agree on something. If they don't, you get a default and all hell breaks loose, which is to no one's benefit. But then the blame game begins, or they do it because they literally want to bring down the system. Or provide an excuse for the Fed to do a complete 180 to printing, because they would under those circumstances. They absolutely would have to. And when I look at the positioning of the banks and bond futures, they'll be one of the best beneficiaries because the Fed will be literally buying the bonds, keeping the yields down, and probably driving them lower to try and restore confidence. Because there's nothing that drives confidence better than like, whoa, I thought it was going to 10%, 20%. Instead of going that way, it drops from 4% down to 2%. And everybody's scratching their heads. How is this possible? Never mind the fact that the dollar's at like 50 cents. But that's we could talk about this all day, but there's so many different permutations. But at the end of the day, it's a blame game. They're very far apart, but something has to be agreed, or else. So I try not to get into that one too much until I see it. It's like when people ask me, so David, what's the CPI going to be on Tuesday? I don't know. I'll tell you based on what I'm seeing. I said, I think the numbers are going to come in higher on CPI and PPI, given the non-farm payroll numbers that we got, which I thought were hyperbole, to put it politely. And I was wrong. CPI and PPI came in lower. But I didn't expect it to blow out. I just expected it to be higher based on the non-farm payrolls numbers. But I was wrong. But you can't, seeing is believing with those things. And just prepare yourself as much as possible in advance of that. I don't try to prepare for 2-3 weeks from now. I try to prepare 1 to 2 years out. Because I'm not a day trader, and never was. I'm a swing trader and an investor. 80% investor and a 20% swing trader. That's how you could describe me.
So more of a longer term focus.
Yes, I'll I go out weeks, months, but on my investments, it's years. I started buying gold and silver many years ago.
Mm. David, we talk so much about this kind of US centric world, about the Fed so much, but there's another big population base within the ECB that, or within, let's say, under the purview of the ECB, that seems to be having, just as many dramatic problems as we do here in the US. So considering, let's say, that the mismatch or the comparative nature of the euro versus the dollar, is there a lot more weakness in Europe that could actually end up driving the dollar higher in the short term here because of some of those issues? Or is it almost a race to the bottom for both?
It is a race to the bottom for both, but I've been saying that for quite some time because what's the term I use? It's like comparing two different brands of toilet paper. One's Charmin Ultra and the other is a Walmart brand. Um, the In the short term, though, in the near term, though, I talked about this and actually attempted a forecast, and it worked out that the ECB was going to come in dovish because the CPI data was lower than expected, and they got a report that the banks were tightening their credit there too. They were going to take a softer approach, and they did. And sure enough, the euro went down and the Dixie went up. And if you actually look back at the bottom in the Dixie, that was the ECB rate meeting,
Mhm.
and it played out as expected. But yeah, there seems to be, at least in the short term, a continuation of that because euro hit a peak. It's coming off. This is technicals now, not so much fundamentals. But I still think the Dixie has a date lower with 92. And then we can decide whether, there's milkshakes got any foundation or not. Um, if it does, it could go to 120, 130, the Dixie, before it peaks and collapses. Alternatively, the dollar just is going down. And the only people who can answer that question are the people at the IMF and the BIS, in my opinion. But in the short term, that's why I don't understand people who throw out these long-term forecasts, and I mean long-term, without a fundamental basis for it, because it could go anywhere. But that's why I like to take baby steps on this stuff and not get, you know, too over my skis on this one. And but in the short term, it certainly looks like you've got a peak in the euro. It's starting to come off. Dixie's getting a bounce now, but I'll be surprised if it gets over 105, 106. Um, but I still think it's got further to go on the downside. And you're right, the ECB is weak. Look, everywhere is weak, and we know this because of inflation. Inflation is everywhere. It's just to different degrees, which is why I use the toilet paper analogy, because they're both terrible, but one's getting weaker faster than the other. And sometimes that changes, but right now it's the dollar's in ascendancy in the very short term.
Mhm. Yeah, I mean, this is one of the challenges that we face constantly, having these conversations, is trying to understand how all of these different dynamics play together and which one ends up being the thumb on the scale that ends up tipping in one direction or the other, I think.
Yeah. And I want to bring up one other point that often comes up to me, and this is another seeing is believing moment. A lot of people say to me, well, can't the dollar and the gold go up together? Yes, they can. They did it from late 2021 into March 22, and then they parted ways again. But if you go back over, years and decades, you will see that, gold is the anti-dollar. But yeah, of course they can go up together. If the euro slides, the pound slides, the yen slides, dollar goes up. But the dollar can go down against, gold can go up against those currencies at the same time. And then, so the two of them just keep going up. But because people focus on gold and dollars, gold can go up in dollar terms while the dollar's going up against everything else.
Mm-hmm.
So basically what's happening is gold is truly appreciating in value or holding its value, but the dollar is depreciating against gold, but it's appreciating against even worse currencies.
Which,
so,
I mean, to your point, I don't think it's been maybe 2 months since we saw all-time new highs in most other currencies other than the US dollar.
Yeah, exactly. So when people say that to me, I say, yeah, of course they can, but they're not doing it now. They're like polar opposites. They're completely, you look at a correlation coefficient, it's like a minus 0.95%, 0.95. What more do you want? That's a near perfect inverse correlation. That's what I mean by seeing is believing. Can they go up together? Yes, of course they can. I'm not fighting that, but they're not doing it now. But could they, like if the milkshake plays out, does that mean gold goes down the toilet? It could, but it could actually keep going up alongside the dollar because everything else is falling first. But the dollar is, as I think you entitled one of our previous conversations, the dollar is scheduled for demolition. If given the plans that are being implemented right now, in order for those to be achieved, the dollar has to
Be
take.
sacrificed.
Yes, that's the word I was looking for. Thank you. It has to be sacrificed because if you want to introduce a new one world currency, say it's like the digital SDR, the US has to step aside as the global reserve currency.
Well, I think even if we take a step back from that extrapolation, which I don't think, that we would get a lot of pushback from a lot of our listeners in this space around that. But even if we take a step back from that, if we're trying to achieve all of these, lofty growth goals, Inflation Reduction Act, greenification, 2030 goals, where does that growth and that productivity come from? Where does that money come from to be able to spend to make those infrastructure investments, to make all of those programs happen? The GDP is not necessarily going to be able to respond to create the wealth effect that is needed to move all of those programs forward. i.e., where is that going to go? We're going to have to print it, which makes just the value go down as an absolute byproduct, because somehow, somewhere, that value has to come from somewhere. And considering the track record of these countries since or before, that seems to be the only option now. And layering on top of that a slowing economy, that's the only outcome for it.
Yeah, and then you got the diminishing marginal returns on debt.
Another great point.
If that's why we're coming towards this great reset. We can't just keep borrowing and borrowing and borrowing and borrowing, and devaluing the currency in the process. So, I honestly don't know the particulars of how they're going to do this, and a lot of people have various opinions. So I'll wait and see it. All I know is that the currencies are going to be devalued, and there are certain assets that I would prefer to be in when that happens, that hold their value over time. I mean, those are obvious. That's basically it. It's tough times coming for us. It's going to be a hard slog. But in the short term, I will say that I'll go back to what I originally said at the outset here. A lot of people are losing faith, and every time it's human nature. When it goes down after being near a new record high, they start getting despondent that here we go again. It's going to drop like a lead balloon, and they see these big red candles on the chart. I think I've said at least 4 times now publicly. After this next low, see ya. It's gone. It's more often than not, if you take like buy low, sell high, more often than not, if you take the approach that when you see the market going down, don't try to buy the dip, but when you see it come down and you see that hockey stick up, then buy it. And then just place a stop where the bottom was. And yeah, you might be right wrong 2 or 3 times, but when it turns out to be right and it starts going the opposite direction, it'll more than make up for the losses. And the same on the other side when you go to a peak. It's just that human nature is the exact opposite. When they see it all going up, like in the dot-com bubble with tech stocks. Oh wow, that's up 80%. Oh, I think I'll buy that now. That's great. You just missed the 80%. There's only like 10% left, and then it's going to drop 50. And the same in reverse. So, but that's the problem with human nature right now, and we're seeing a pullback in gold and silver. This is healthy. We were extreme bullish, we were extreme overbought. What does a pullback do? It resets that. What happens next? When we go up, we have the fuel to break out the previous high. And when we break out that previous high, it's just going to shoot higher. And then we'll hit a new peak. What is it? 2,300, 2,400. Then we'll come back down again. You'll get despondent again. And I'll be sitting there waiting to buy it again at like 2,000. And then we go to 3,000. My process was developed by going and looking at and it didn't take a day, I would say with months, but was looking at the major peaks and troughs in every asset, going back to 2006, where I could get COT data, and looking for patterns, and they're consistent. Now, there are different emphasis depending on the asset. So for something like nat gas, fundamentals are the primary consideration. Then you've got COT data. By contrast with gold, sentiment is huge because gold bugs, silver bugs are hugely emotional about that sector. But my point is that when you look at those peaks and troughs, it tells you that you should have bought at the low. And here's why. You saw the MACD was in the toilet. You saw the RSI was below 30. You saw the sentiment was extreme bearish. You saw that the banks were massively long at the low. You just put the pieces together and you go, okay, it doesn't guarantee you, but it increases your odds from 50-50 to 60 to 70-30, and that's all I do. And so the other thing I will say is, yeah, I have opinions and I'm sharing them with you and you're sharing yours with me, but mine are backed by data. I don't just bull this out of my rear end. I'm looking at it's like throwing mud at a wall and looking for a pattern. But this is a little bit more scientific in that I look at the fundamentals, I look at the positioning, I look at the sentiment, I look at the intermarket analysis, I look at the Elliott waves and the technicals. And when I put those together, and they all say the same thing, you can have a high degree of confidence that you're going to be correct. And I have trouble after this pullback in gold and the rest of the sector, how we don't go up. I don't see it. When the crash comes, as you alluded to earlier, sure, but we're not in a crash right now. In fact, everybody's bearish the stock market. What typically happens when it's bearish? It goes up. And it's not the economy. The economy will keep going down. You'll see more unemployment and so forth. But as we learned, was it in 2019 when we were coming out of that crash, people were saying, oh, it's all over and so forth. No, here comes liquidity. Liquidity is what drives markets, prices. If there's enough buyers, it goes up. It doesn't matter what the economy's doing. That was the analysis 20, 30 years ago. That's not the way we live now. You could have you could have a depression and the stock market hits new all-time highs because the Fed's printing money and it's buying ETFs like Japan was doing, but the economy's still like either stagnant or falling. I'll end my vent there.
I think that's a great place to wrap up today, David. We've touched on so much, and again, hopefully this was helpful to help some understand how some of these balances, some of these forces, everything ends up balancing out. And I appreciate you sharing your thoughts with us. Of course, you write a lot for Sprott Money. A lot of your articles are available there, and silverchartist.com. And I think you link to all those from your Twitter at Global Pro Trader. Is that correct?
I'm not a global pro trader anymore. I just silverchartist.com. Sorry, Global Pro Trader on Twitter. You're absolutely correct. I was thinking of something else. So the other thing I wanted to mention just before we go, the reason why I focused on that part at the end is, we have all these podcasts and some people throw out these long-winded targets. And sure, I have a big picture number as well. I mentioned 3,000 gold and 50 minimum for silver and GDX, and then 30-40 for SILJ. But it's to reassure those people who have a day job but are interested in gold and silver, don't watch this as much as we do, and so forth, and may not have the time to, may not be able to spend the time to get the level of expertise that's necessary to be able to do it. But this pullback, nothing is guaranteed. This pullback is, in my opinion, the last pullback you're going to get before we have a new record high. And as I don't know, I'm not saying it's done yet, but we haven't even hit my minimum target in gold of 1990. I haven't seen the screen since we've been talking, so maybe it has, but it's not there. That's minimum target. Could go down to 1900. But from there, we go to new record highs. That's the takeaway I want you to have from this. And I'm not saying bet the farm on it, but I have a high degree of confidence that's going to happen. But I could be wrong. But that's what I'm going to be doing. I'm going to be layering in at 1990 and below. And I expect the next peak will be well in excess of the previous high of 2889. I'm thinking 2250, 2300 conservatively. And that's what I want your listeners to go away with.
Yeah, it seems like risk reward at this time definitely favors the upside.
Yeah, if you buy at 1990, this is worst case, and it drops below 1900, and you place a stop below 1900, well, you're down $90. But you were targeting 2250, 2300. Okay. And then it comes back up again. And then you buy, you're still going to make that 90 plus something on top of that. Whereas if you layer in from 1990 down to 900, you might have got in around 1945. And it goes to 2250, 3000, or 2250, 2300. The risk reward is obviously in your favor, like 8x or something along those lines. So buy low, sell high. It sounds so simple, but most people don't do it. They do the exact opposite. They buy high, sell low. Try and if you can take emotion out of the situation, you're 90% of the way there. Or fight your own emotions. Do the opposite of what you think.
Yeah. Well, David, I appreciate you sharing your thoughts with us today. As just a reminder again, at Global Pro Trader is your Twitter handle, and
That's correct.
Link to everything from there. David, thanks so much for your time today.
Thanks, Tom. Pleasure as always.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.